And the one thing you'll be sure is if you do come out of whatever you own, whether it be gold or silver or Bitcoin or equities or property, you are going into an asset, specifically cash, which is being printed faster than it's ever been printed before and for which there is no hope tomorrow.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 8th through April 15th, 2025, while supplies last. First this week, we feature 2025 1-ounce silver Canadian maples at just $3.49 over spot per ounce. Constitutional or junk silver is just $1.99 over spot per ounce. 1 10th-ounce Platinum Britannia are just $29 over melt, and 1 10th-ounce Gold Britannia are only $27 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, a retired wealth manager in Switzerland. Clive, thank you so much for joining us today.
Hello, good evening, Elijah, and thank you for having me on your show. It's quite late in the evening here. It's 9 p.m. I guess you're a little bit earlier in the day.
Definitely. Just noon here in Arizona, but we really appreciate you taking the time late in the evening there. I did want to discuss, what happened in the gold and silver markets this week and also the stock market. It seems like the stock market had a huge rebound. Was it on Wednesday and then a sell-off again on Thursday? It seems like the stock market is in turmoil, but gold and silver are rallying, gold making new all-time highs above $3,200 an ounce. So do you think the tide has shifted where it's, no longer sell-off in precious metals, but now moving, money is moving from the stock market to metals?
Well, a lot of questions there, Elijah. It's been a wild week. First, we had the tariffs and the stock markets plunged, and gold went down with it, but not as much. Then we had a rumor that maybe they'll delay the tariffs by 90 days, and the stock market soared. And then President Trump, denied that and said there's absolutely no way we're going to delay the Trumps. They're definitely, we're not going to change a thing. And stock markets plunged again. And then the next day, Mr. Trump announced that we are delaying the tariffs for 90 days. And the stock market soared again. Now, you have to wonder what's going on here, because reality is nobody really knows where they're standing. But what's been going on as this has all been happening is gold has been holding up very well. And as of today, we are sitting at an all-time record. Yet the stock markets are down a good 10 or 15%, depending on where you look. So I think what's happened is the bubble in the high-tech stocks, in the NASDAQ, in the Mag 7, I think I'm not going to say it's burst, but it's deflating because the earnings expectations of these companies they were high and they're still high, but just a little bit less high. But when you adjust the rate of growth on a high multiple company, that can change the price a lot. And that's what's happened. We've seen these major stocks come down, in fact, most of them more than 20%. So people who've been into these stocks are now saying, well, they bought the dip and then it's gone lower after the dip. So they're starting to look around for other things. And I think this is where gold has been flying, because the asset allocators are now starting to redo their sums. And they're saying, what would have happened if we had an allocation of 2% or 5% to gold? And the maths says that would have reduced risk, reduced volatility, and improve returns. So asset allocators, for the first time in decades, are starting to add gold back to the portfolios. And we've seen in the last few weeks that gold has, in fact, been flowing into the gold ETFs, whereas for a few years, the quantity of gold in terms of tons in the ETFs has been going down. Now it's starting to rise. So the feeling is that the man in the street is starting to buy gold, both physical gold and going into the ETFs. Now, probably this is the first time you've heard me say it, because I've been constantly saying this gold rally is not the man in the street. it's been central banks and large strategic buyers, the sort of buyers who are able to take delivery of 100-ounce bars out of COMEX. Now, 100-ounce bars, we're talking about $300,000 or something like that. It's a lot of money. So these buyers were not mom and pop, but I think mom and pop is starting to come back into the market, but only very tentatively at this point. And I think that is why we've seen the gold price. It takes a very small amount of money to move the gold price and the gold mining sector. I mean, we're looking at the gold mining sector. I looked today, GDX, for example, that's the ETF, which tracks the largest gold mining companies, up 5% on the day. So people are starting to think, how can I get exposure to the gold market? And I think that's coming back now.
Now, there is so little funds invested in the gold market. If you look at, normal asset managers and all that if we just see a small movement into gold, it seems like it could have a tremendous impact on the price. Your take on that, and where do you see gold heading from here?
Yeah, when I first arrived in Switzerland in 1985, it was fairly traditional. Every portfolio in a Swiss bank would have about 5% exposure to gold. But as the years went by, that exposure started to drift down, particularly from the year 2010 onwards. So gold was very, very strong up until about 2010. It had gone from almost, under $100 up to over $1,000. And then from 2010, it didn't really do very much for another decade. And as that decade was passing, stocks were performing extremely well. So money was coming out of gold all the time and going into stocks. So by the time I retired, which was 3 years ago, the official allocation of the bank where I worked and many other banks to gold was actually zero. Now, we had in terms of investment management, we had a tolerance of 5%. So you could actually get to your 5% gold if your clients believed in you believed in me, and they did. So we actually had a little bit more gold than we should have done according to the asset allocation tables, which should have been officially zero. But those numbers are now starting to come back. I got an email from a Swiss bank just probably 2 days ago, which it was, when I say it was an email, it was a PDF investment recommendation report, 2 pages of what we should be doing about tariffs. And then right on the last line, they sort of added as an afterthought, another way to sort of protect yourself is to have some gold in the portfolio. And it was almost like an afterthought. So it's coming. I think the gold is coming into portfolios. And so I believe we probably have a long way to go, not least of which because the central banks are probably likely to be buyers more than ever. I mean, if you think what's happened in the world, we've had these very aggressive and surprising tariffs, not only on people or countries which Mr. Trump sees as his enemies, but also on countries which are supposed to be friends of the United States. Take Canada, for example. Very aggressive tariffs put on Canada, and Canada has retaliated. And 2 countries which love each other and at total peace suddenly are having a spat over tariffs. Now, what's Canada saying? They're saying, well, I don't know what they're doing, but they must be thinking, can we trust what's going to happen next out of the United States? They punished us once, are they going to punish us again? What about all these treasury bonds we're holding? Now, Canada does not hold any gold, but it wouldn't surprise me one little bit if they're now rethinking that, and maybe they're one of the buyers of gold, which we don't know yet. We'll know that in a few months when the figures get reported.
I guess still on gold at the moment, it's pretty impressive that gold is making new all-time highs and the stock market is still significantly down. If we compare this to what happened like in 2020 or 2008, when we saw a huge sell-off in the stock market, it seemed like it took a while for, precious metals recovered faster than the stock market, but it still took a while. But this is just, a week and a half, and golds are already again making all-time highs, recovering from the sell-off it saw. So your take on that, it seems like there's a big move or a big shift happening already.
Well, first of all, gold has been well supported by central bank buying. China bought some more gold last month. That's in March. It was less than usual, but they bought gold nevertheless at an all-time record price. All the evidence is that central banks who are buying gold don't really care what the price is. They just want it. And I think the recent events with the tariffs will only accelerate the desire of central banks around the world, whether they be friends or enemies of the United States. It will accelerate the desire to have more choice than just US treasuries in their foreign exchange reserves. So, for example, this week we've seen quite a big decline in the dollar. It's gone from, if we look at the Dixie, the DXY, which is the dollar index, it's gone from 103 to, at one point, below 100. It's slightly above 100 as I speak. And a few weeks ago, it was 109, 110. So it's come off quite a lot as people have been basically bailing out of the dollar. And I think I don't think this is necessarily people selling as private individuals selling the dollar. I think it's more likely that central banks, again, are saying, why are we so exposed to the United States with everything which is going on? And they're probably investing in European central bank bonds. They're probably investing in British gilts, even Japanese bonds and Swiss franc bonds. And the reason I say that is we've seen in the last few days quite a heavy sell-off in the US 10-year. We've seen the 10-year go from about 3.9% yield to 4.5% yield. It's just under 4.5, 4.49, something like that percent yield as I speak. So when the yields go up, that means the price of a bond is falling. So the US Treasury 10-year bond, the price is falling rapidly, but the prices of the bonds in other countries like UK, Europe, Switzerland, has not been falling in the same period. That's unusual because usually bonds around the world tend to be fairly correlated. They tend to move to some extent in tandem with you. I know I'm not talking about the long term, I'm talking about in the short term. Japanese excluded in that. So what that implies is that people, I think central banks are probably reducing their exposure to US treasuries and are probably increasing their exposure to other things, including bonds issued by other governments.
Now, when it comes to the dollar index, it seems like it's kind of riding the line of 100 right now. It dipped below it earlier today. Now it's slightly above. Do you see that level being significant if it really firmly breaks through that level?
In a way, I'm struggling. I mean, I think there's two pulls on the dollar. One is upwards, one is downwards. Now, logically, when you impose tariffs on foreign nations, you buy less foreign goods. What does that mean? It means that you're sending less dollars overseas, and therefore your current currency should rise, not fall. But actually, it's falling. So what's happening is the currency is being overwhelmed by people who say, you know what, with everything that's going on, I don't trust what's going to happen tomorrow. No idea what's going to happen tomorrow. I have uncertainty. So they're selling US equities. They're taking that money home to their domestic currencies and basically selling the dollar. So at the moment, I think that's what's going on. There's net selling of the dollar because people don't know what's going to happen tomorrow. But realistically speaking, if you reduce your imports from foreign countries, you're paying less money overseas. Logically, your currency should rise, but that's not happening as we speak. So, in answer to your question, do I think the dollar index is going to go lower or higher? I'm sort of sitting on the fence. It could go either way because we got these two pulls going in opposite directions.
It seems like this has been a pattern for years now, where the world is slowly moving away from the U.S. dollar. But it seems like it's really happening for investors as well, as they feel less secure holding U.S. debt.
Yep. Investors who've been investing in U.S. equities have had a very good run for 12 years. And, there comes a time when you suddenly start to feel uncomfortable. And I think we've hit that point of uncomfortableness, and people are starting to say, well, let's cash in some of the chips. And if you happen to be outside the USA, cashing in your American chips, i.e. your US equities, it's unlikely that you're going to leave them in the dollar, a country which hasn't yet shown much in the way of managing to get its deficit down. So you're likely to bring that currency back home where you feel safer, where you feel more comfortable with it.
Now, when it comes to gold, obviously we're seeing all-time highs. Silver is not at all-time highs or even near all-time highs. It's rising the last couple of days back above 32, but it's still down from where we started before the stock market started really selling off. So what is your take on that? Is silver acting more as an industrial metal right now, safe haven? What do you make of this?
Well, I've seen countless people commenting that gold has reached a certain level, $34, $33, $35, which they kind of see as a trigger point for the bull rally. I think we're going to have a rally, but I think the cutoff point where it starts to accelerate is somewhat higher than that. I'm talking north of $36 somewhere. But if we get above $36 and stay there for a few days, I think it's an easy ride up to 40 and beyond. Silver, of course, is going to be supported in the medium term by the simple fact that the mined supply of silver has been declining for a decade or more, and the consumed supply of silver is rising fairly rapidly. And the biggest consumption of silver, or the fastest increase in the consumption of silver, is coming from the electronics industry. Now, I know, and you know, that there will be more electronic goods on this planet next year than there are this year, and that's going to consume a lot of silver. So the estimates were that last year the electronics industry consumed 20% more silver than the year before. That might have been 23 to 24 or 24 or 23, 22, I can't remember now, but suddenly the Silver Institute was saying silver consumption is rising by 20% a year. And of course, the biggest component of that was the photovoltaic industry. And I've got a strong feeling that photovoltaic sector is growing quite fast. I mean, I'm getting far more knocks on my door than I've ever had from people trying to sell me solar panels on my roof. So I think it's become quite a mania in that area. But certainly the fact is, silver consumption is rising. We've passed the point where the consumption exceeds the mined supply a couple of years ago. The deficit's getting larger. The silver price has risen from around $20 to around 30 something, which it had to rise to suck out the scrap silver to fill the difference. And I think as that difference is going to get larger in the next year, probably the silver price has to go higher. But I don't think it accelerates away until we're above $36. I think it will just drift. It'll have its bad days and its good days. Nothing goes in a straight line. But we need to see it go above a certain level before it starts to suck in investors who say, I think I'd like to have some of that in my investment portfolio. I don't think there's a great deal of interest to buy silver bullion amongst the general public. I mean, the people who watch your show, they're intelligent people, so they're doing it. But there's an awful lot of people who just have no clue what the price of silver or gold is. I see that every day when I talk to my friends.
Now, when it comes to the efficacy of these tariffs, do you see that this is a good idea for the U.S. economy? It sounds like at least the reaction from a lot of investors that you're seeing is that there's so much more uncertainty now. But also coming from a non-U.S. perspective, do you think this is a good idea for the U.S. to be engaging in? People have called this trade wars at this moment.
Well, so far it seems to have been an indiscriminate trade war. It's not very targeted. I mean, it's targeted by countries, but the basis on which it's being targeted on the countries doesn't make a lot of sense from my perspective. So first of all, when you impose tariffs, it means that the cost of things in your own country in general will rise in price. Now, one can call that a one-off, but there's winners and losers in that in terms of the domestic industry. So if we talk inside the United States, there will be some companies who manufacture goods and services inside the United States where they've had hot competition from imports from foreign countries selling cheaper. And that's going to be not such hot competition. So those companies will be able to sell more and make more profit. And that's obviously what Mr. Trump is talking about, and that's what he wants to do. He wants to bring manufacturing back to the United States. But at the same time, there's many companies in the United States who have supply chains outside of the United States. They may be making cars or machinery, and they're buying parts and components from all over the world. And as these parts and components come into the United States, they're going to be taxed, and that's going to put up the cost for those businesses in the United States, meaning those particular businesses are going to have to sell their goods at higher prices, and they'll be selling less of their goods, which means that over time, they'll have to lose, some people will lose their jobs, and the profits of those companies will be lower than they were because the margins will be squeezed. So it's not a one-way ticket for America. There will be winners and losers in America on this. But I think what it will do is generally it will gradually lead to a rise in unemployment and a slowing of the economy. I think we will get a recession in the United States. I think we'll get a recession globally. I'll come to that in a second. And obviously when that happens, that means the tax take will go down, and the ability to therefore manage the budget deficit will be reduced because they'll be spending a lot more money on social security, on unemployment pay and things like that, which will mean that investors will lose confidence in US debt faster. And if we go to the right to the end of the game, eventually we'll get to a point where the interest rates at the short end are falling rapidly as the Federal Reserve reduces interest rates over and over again to try and stimulate the economy. For the I'm absolutely sure the Federal Reserve is going to say the price hike is a one-off, unrelated to our monetary policy. It's not, so therefore we can ignore it. So the Federal Reserve is going to say our second policy is to try and get full employment, so we'll start to reduce interest rates. So I do think we'll get multiple reductions in short-term in rates, but the longer rates, the 10-year rates, I think they're going to be rising as people start to lose confidence in the ability of the government to manage its ever-expanding national debt. And we mustn't forget that we're seeing these Treasury yields rise at the moment at a time when there is a freeze, absolute freeze, because we reached the debt ceiling on increasing government debt. That freeze arrived in January this year, on the 3rd of January. So at the moment, to pay the bills, the United States is running down its treasury balances and raiding the government pension plans by not investing money into the pension plans. And by August, all those emergency measures will have run out. So they will probably, before we get to August or by August, have to raise the debt ceiling again. If they don't, they will default. But that's a very unlikely scenario. So we'll assume that they'll raise the debt ceiling in August or maybe in July. And when that happens, the government will have to go into the market and borrow a huge amount of money, hundreds of billions, maybe trillions of dollars to replenish the coffers, to put the money they've taken out of the pension funds back into the pension funds. So there'll be a rush to borrow money, and the market may not be able to absorb it, particularly if foreign buyers, foreign central banks, are not as present as they used to be. Now, there are some plans afoot, which I'll come to a little bit later, which would maybe change that. But the reality is we might have a debt crisis, a Liz Truss moment, if you know what I mean, a Liz Truss moment, where suddenly yields are starting to spiral above 5%. We're at 4.5% on the 10-year already. And when that happens, there'll be a lot of pressure on the Federal Reserve to be the lender of last resort. So what happens then is, although the Federal Reserve doesn't buy directly from the Treasury, it will pass through a broker-dealer on the way. But what happens then is the Federal Reserve starts to expand its balance sheet, its quantitative easing. It buys government bonds using cash, and the way it gets this cash is to print it. So on the liability side, it increases the cash, which is just printed, and on the asset side, it increases the assets, which are the bonds it's just bought. But when, of course, it starts printing all this money to buy these bonds, that's pumping short-term liquid money into the economy, which means that someone somewhere is getting it, and asset prices are likely to rise very, very rapidly. That would include the stock market. So long before we get to that point, the stock market will be recovering because the stock market will be anticipating that this is going to happen long before it actually happens. So probably just when we think the news has got as bad as it's going to get and it can't get any worse, that will probably be the moment when the stock market turns around on a sixpence and goes back up again. Now, the question was, is it good for the economy and world? Well, clearly overseas, many countries have part of their exports go to the United States. I think China currently is about 14% of their exports going into the United States. Other countries, some more, some less. So all these countries are likewise going to see job losses because they'll be exporting less to the United States. And therefore, they'll be having recessions of their own. That in the short run is bad for the stock market, but once again, we'll have exactly the same kind of situation where sooner or later, the foreign central banks will follow the lead of the Federal Reserve and step into the market as lenders of last resort to their governments, who will be trying to reflate the economy due to the recession.
It sounds like, a lot of, again, uncertainty going on here. And that's what investors are really expecting here, is they don't know what is coming ahead. And it sounds like, at least around the rest of the world also, a recession is likely. And I know JP Morgan just put out a forecast. I think they were the first bank to forecast a recession here soon. So going forward, what is your suggestion to our viewers who are concerned about their finances in this time? What are some avenues you think, maybe besides gold and silver, that will do good during this time, do well during this time?
Well, first of all, if anybody feels uncomfortable about any of the asset classes they probably hold too much of it. They should sell a little bit and then see how they feel. The second thing I'd say is, in the long run, the one asset class which will buy less and less and less is fiat money, paper. We've had, since the United States went off the gold standard in 1971, they've been printing dollars like there's no tomorrow. They've been exporting those dollars to foreign countries who've been then manufacturing goods or selling goods to America in exchange for paper, so selling their hard-earned labor for paper, which America is now saying, well, you've been cheating us. So the question is, what? Nobody's been cheating America. America's been benefiting from the ability to buy lots of really cheap goods that they couldn't manufacture themselves at those prices. But now, as Mr. Trump has said, that has to some extent decimated many American industries who had hot competition from countries overseas who could produce it cheaper. But one of the things which I think was missing in the calculations done when these tariffs were imposed, they were only looking at the trade in hard goods. They didn't look at the trade in services. Now, in many cases, these foreign countries are buying a lot of services from the United States. So, for example, Switzerland, which is one of the countries which has been heavily punished because America exports less to Switzerland than Switzerland exports to America. But when you add in the services sector on both sides, which are supplying on the other side, you'll find that the figures are very, very roughly the same. So there is no deficit. And if I calculate it according to the number of jobs that Switzerland is creating in the United States, we're creating about just over 1 million jobs through our purchases of goods and services from the United States. And our salaries are slightly higher than the USA. And America is creating just under 1 million jobs in Switzerland due to the services and the goods that it buys from Switzerland. So we're pretty much, in Switzerland, we're pretty much on an even keel. Yet the tariffs imposed on Switzerland before they postponed them were very high. I think it was 41% or something like that, which only reflected the movement of physical goods and not the movement of services, where both sides are more or less balanced out.
Now, I know in previous podcasts, we've talked about the flow of gold and how there was a lot of gold coming from London, and also a lot of gold flowing out of the COMEX as well as silver. Did you want to give us, before I let you go, kind of an update on this, how it seems like it seems to continue here where the big money is making moves into gold and silver and taking it off of the exchanges?
Yeah, well, I mean, perhaps when we last spoke, a lot of people were saying that gold is flowing to the United States because it wants to beat the tariffs. But we now know that there are no tariffs on bullion. Yet the gold price isn't coming back as people say, oh, there's no tariff, I can sell it back. The gold price is moving to record levels. So we can actually deduce that the movement of gold to the United States and then the subsequent delivery of 100-ounce bars out of COMEX is because somebody actually wants that gold in their possession. Now, I don't think it can be China, because it wouldn't make any sense for China to ship gold buy gold on COMEX, so it could be shipped from London because they could just bought it in London directly. So I don't think it's China. So I think there's 4 possible candidates here. Of course, there will be some hedge funds who are taking a position. The second possibility is it might be the US government itself for various reasons, which we've all talked about, including remonetization of gold, including the question of whether the gold is really there to start with in the first place, and they're now getting ready for an audit. I think the gold will be there, but I'm just sort of saying what people are saying. The third possibility, for very good reasons, which I've outlined in writing, it might be Berkshire Hathaway, who have made comments in that direction in their latest quarterly annual report. And the fourth one, I think it might be, I've said at the beginning of this program, what about Canada? It wouldn't surprise me. Canada, who's got no gold, will say, God, we better wake up and get some.
Very interesting there. What was it about Berkshire Hathaway that makes you think that they might be acquiring gold?
Okay, so Warren Buffett grew up in a gold bull family. His father, who was originally a poor man, became a very rich man by becoming a stockbroker in the middle of the Great Depression, when nobody had any money to buy stocks, but nevertheless he made a lot of money. And he made so much money that he could go on and buy a bigger house and have servants. And he was elected to be a senator in the United States 4 times. And in his role as senator, he frequently spoke out against the fact that America had effectively gone off the gold standard for American citizens and was calling for a return to the gold standard. And he basically said things like, I can find no example in history where this ended well. Of course, America is a very large country with a very strong economy, so it will take longer, but the end result will be no different from what we've seen in places like Russia, where we had Bolshevism, or Germany, where we had Nazism, or China, where we had communism. The result has always been a bad ending when countries have separated themselves from the gold standard. So Warren, as he was growing up as a teenager, he'd have been sitting in a household where he heard nothing but talk about gold around the dinner table with his father's friends. And his father was giving to his, obviously fearing, and the father would say this, that he feared that the currency would go to zero. So he was buying for his daughters gold bracelets. Now, Warren, what did he get? A train set. Now, I don't know how Warren felt about it, but perhaps there was a little bit of jealousy there. So come the 1960s, gold is still illegal to own in America. And Warren Buffett, by his own admission, now his father's dead, he buys a lot of silver. He's a silver bull, can't buy gold, but he buys silver because he can't buy gold. And then we get to 89, I think it is. And without the permission of Charlie Munger, he buys an absolute tons and tons of silver. I think it's about 30% of all the silver in the market. And obviously Charlie Munger, he doesn't say it like this, but he's clearly not too pleased. The way Charlie Munger put it at the shareholders meeting was something along the following lines, and kind of laughing. He said, well, if this amuses Warren and keeps him out of trouble, it's only 2% of our assets. Let him do it, laughing. But obviously, he and Warren Buffett and Charlie Munger had an argument about the fact that Warren had deviated from a strategy of buying businesses which produce profits and had bought some rocks, in this case silver, which just sits there and looks at you, as they might say. So having upset Charlie Munger, I don't think Warren ever dared to buy any more gold or silver after that. Now, we know that happened because before we got to the annual report, Berkshire Hathaway was forced to disclose their purchases, and they came out with a statement maybe 4 or 5 weeks before the annual report saying, oh, by the way, we bought this many tons of silver, and we just want to make it clear that if some of it's not been delivered yet, it's not due for delivery until March, but for those who can't get their hands on the silver and can't deliver it, we're willing to give them an extension in return for a reasonable fee. This was what they wrote. So obviously they'd had a rap across the knuckles from the CFTC saying, you're trying to corner the silver market and we're not having it, just like the Hunt brothers were told to stop it and actually forced to stop it. So to sort of sweeten up the CFTC, they obviously offered to give everybody, that we're not cornering the market. We'll give you, if you can't deliver the silver, we'll give you an extension and charge you a small fee. So now Charlie Munger died a year or two ago. There is no constraint whatsoever on Warren Buffett doing what he wants to do. And if you read the latest annual report, there's a line in there in which he says, and I haven't got the precise words, but the gist of it is, you're a fool if you are holding on to a lot of government bonds. We've reached the 11th hour, or words to that effect. So my question is Berkshire Hathaway following their own advice and getting rid of this vast cash pile, or not? We can't know because there's no obligation on Berkshire Hathaway to disclose whether they have or have not. If they buy securities, they have to disclose. But if they buy gold and silver, they don't have to disclose anything. So it wouldn't surprise me if they deployed some of their cash into gold. And so they might be a big buyer.
Well, it should be interesting to see maybe as this all comes out, but I think that's a very interesting perspective there. And it would be interesting if Warren Buffett is buying a whole bunch of gold now. So thank you so much for sharing that. And are there any last thoughts you have for our viewers?
Well, what we're seeing today, I've seen countless situations. I've been investing money for 50 odd years, and it's not every year or even necessarily every decade, but it's happened many times in my career that we've seen situations which look as dire as it looks at the moment. And sometimes these situations for the stock markets are very short-lived, and sometimes they can last a decade. We don't know which, but sooner or later, it will come right. Businesses and directors of companies have a habit of figuring out which way to navigate the muddy waters. And the one thing you'll be sure is if you do come out of whatever you own, whether it be gold or silver or Bitcoin or equities or property, you are going into an asset, specifically cash, which is being printed faster than it's ever been printed before and for which there is no hope tomorrow.
Definitely a dire warning there to our viewers, and we really appreciate you sharing your insights, telling our viewers, how can we protect ourselves in this time? That's what our channel is for, is being aware and prepared. We don't give financial advice, but we really appreciate your insights here. Once again, thank you so much for your time, Clive, and God bless.
Thank you very much, Elijah.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for April 8th through April 15th, 2025, while supplies last. First this week, we feature 2025 1-ounce silver Canadian maples at just $3.49 over spot per ounce. Constitutional or junk silver is just $1.99 over spot per ounce. 1 10th-ounce Platinum Britannia are just $29 over melt, and 1 10th-ounce Gold Britannia are only $27 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.